If you've ever opened your health insurance paperwork and zoned out when you saw the word deductible, you are far from alone. But beneath that dry-sounding technical term lies something that could change the way you use healthcare, the way you think about risk, and even whether you go to the doctor when you really should. Most Americans don't fully understand just how real the cost of their deductible is until it slams into their finances or their health. This is the quiet burden hiding in many health insurance plans, and the truth about deductibles matters more than ever. Imagine this. Anna, a 34-year-old graphic designer, skips calling the doctor about a lingering cough because she's worried. She has insurance through her job, but her plan has a $1,900 deductible for individual coverage. She calculates in her head. If she goes in, diagnosis and treatment might cost her hundreds or even $1,000 out of pocket before her insurance even starts to kick in. So she waits another week, then another month. Her cough turns into bronchitis. She ends up in urgent care, and the bill is much larger than if she'd caught it early. That story is real for a lot of people, and it's happening more and more. Here's the truth. Deductibles in health insurance are not just a price tag you ignore until you need care. They're a major lever, shifting risk, reshaping behavior, and quietly driving financial stress. As health costs go up, many employers are pushing more of the upfront burden onto workers. Meanwhile, people underestimate how likely they are to hit that deductible when something serious happens, and how much that can cost them. So what's really going on? First, it's important to understand that not all deductibles are the same. Some plans, especially those called High-Deductible Health Plans, HDHPs, ask for a large upfront payment before insurance shares any costs. These plans often go hand in hand with a health savings account, HSA, a special savings tool that lets you stash money pre-tax for medical expenses. For 2025, the IRS stated that a qualifying HDHP must have a minimum deductible of $1,650 for individual coverage or $3,300 for family coverage, and the out-of-pocket maximum, which includes the deductible, copays, and coinsurance, but not premiums, for these plans can go as high as $8,300 for individuals and $16,600 for families. That means you could pay that much before your insurance really begins to pay. Those are full-on risk exposures. Why are things getting so steep? For starters, the cost of healthcare has been climbing, and so have premiums. Employers, feeling the pinch, are responding by ratcheting up deductibles instead of absorbing all of the increases themselves. The result? More cost is being shifted to employees. While HDHPs might save you money on your monthly premium, they front-load risk into what you pay when you actually need care. But the numbers tell a deeper story. According to recent employer surveys, nearly 9 out of 10 workers with health coverage are in plans that require meeting a deductible before most benefits apply. And for many people in those plans, the average individual deductible is almost $1,900. In smaller companies, which often have fewer resources, the deductible can be even higher. That matters. Because when deductibles are high, many people begin to think twice about going to the doctor. A compelling piece of emerging research put this into sharp relief. When cost sharing is reduced, in other words, when people don't have to pay so much out of pocket, emergency department usage actually spikes, and not all of that extra use is unavoidable. In a study that used a kind of accidental, natural experiment, researchers found that once someone in a family hit their deductible, lowering their out-of-pocket burden, emergency department visits rose by about 10 percentage points, and a significant portion of that increase may have been avoidable. At the same time, preventive wellness visits that weren't initially subject to cost sharing actually decreased. suggesting that cost-sharing shapes behavior in subtle and troubling ways. The practical consequences are profound. Many Americans simply don't have the cash reserve to cover thousands of dollars in medical costs if the worst happens. Even if insurance is there, the upfront cost can be a barrier, not just to care, but to financial stability. People delay or skip care. They accrue medical debt. And this isn't just for the uninsured. A growing share of medical debt is held by insured patients who couldn't or didn't pay their share. That kind of stress ripples out. A large unexpected medical bill can eat into your savings, force you into debt, or even upend your credit if things go wrong. Medical debt is notoriously difficult to manage, and for many Americans, a costly illness or injury can mean years of financial fallout. So what do you do if you find yourself staring down a daunting deductible? First, don't assume that the plan with the lowest monthly premium is your best bet. More often than not, the low premium option means higher risk when you need care. During open enrollment, run the numbers. How much care do you realistically expect to need? And how much will you pay out of pocket under different plans? Do you have access to an HSA? And if so, could you realistically build it up enough to cover a potential deductible hit? If using an HSA is part of your plan, treat it like a health fund. Try to contribute regularly, even if it means small, consistent deposits. That way, you're building real financial resilience. If your employer also contributes to your HSA, that's all the more reason to take advantage of it. But don't forget, not all HDHPs are created equal. Some have higher out-of-pocket caps than others. Some offer more generous employer HSA contributions, and some aren't even HSA eligible, even if they meet the deductible threshold. Advocacy also matters. When you talk with your HR department, ask hard questions. Why did deductibles go up this year? Are there lower deductible options available? Does the company provide any help to fund HSAs? These questions are not just personal. They influence how benefits are designed at a systemic level. You're not just negotiating your own coverage. You're pushing for transparency and fairness in how costs are shared. At a broader level, there's a growing policy conversation. As more workers face risk shifting, there's pressure on lawmakers and regulators to think about out-of-pocket maximums, cost-sharing subsidies, and how to make healthcare more affordable without eroding access to care. Some research suggests the way subsidies are targeted in health insurance marketplaces could be optimized to protect lower-income enrollees, especially as premium assistance evolves. Others argue for redesigning plan tiers so that preventive care and chronic disease management are more accessible without waiting for deductibles to be met. It's not just about survival. It's about figuring out how to use health insurance as it was intended, not just as a safety net, but as a real partner in keeping you healthy. If you treat your deductible as just a hurdle you'll cross once and forget, you might be underestimating how often it comes back into play, or how deeply it can affect both your health decisions and your wallet. So the next time you glance at your plan options, don't just ask what the premium is. Ask how the deductible works. Ask how often you expect to use medical care. Ask whether the savings tools like HSAs make sense for you, not just theoretically, but for your real life. Because the truth about deductibles isn't just financial theory, it's real money, real decisions, real consequences. And for too many people, it's the biggest invisible risk they're carrying in their health coverage.